Okay, traditional versus Roth IRA. We're going to go over some of the simple things, some of the medium things, and some of the more advanced things for you. And we've got actual slides. But first, welcome back, Eric. You've been a while. I missed you.
You missed me for real?
I missed you.
I like to hear that. I'm glad to be back. Glad to be back in the saddle.
I love it.
No more extracurricular activities for Eric. I'm done. I'm just like,
Respect.
I'm done.
100%. Yep. It was gone. You see some of the comments, people?
Like,
we think you killed Eric, or like, is Eric still there, or where did Eric go?
Well, am I just AI generated right now is the question.
I know. Is it real or not?
I mean, is everything lining up on what I'm saying?
Slight.
Like the voice,
Have
you
ever seen that, by the way?
What?
Like, it'll be Martin Luther King. I sent it to Cody the other day. He's like, I have a dream that one day my 9-leg parlay will kick in, and it's so perfect. That's fake, but some of it is really hard to tell.
Yep.
All right, let's get started on this here. So beginner sort of focus here. We got IRA, we got a Roth IRA. Ultimately, just trying to decide whether you want to have one or the other or both, right? There's some scenarios where you can actually have both. And IRA in general, real simple. You're putting money in, and for the most part, you're getting a deduction for the money that you put in that year. And so people use it because they're like, well, I'll pay tax in the future. I think I'll pay less tax in the future, and so I'd rather get the tax break now. So your limits, you got $7,000, $8,000, of course, if you're over the age of 50. There's some new rules there with the OBBA. That's what we're calling it.
Oh, really?
That's what they call it.
It's not the big beautiful bill?
Yeah. One big beautiful bill act.
Oh, wow. That's
OBBA.
It's a lot of words. Okay.
If you're searching it,
Okay. Got it.
So anyways, the concept there is you're putting money in, you're getting a tax deduction. Real simple. The money grows, and then over time, you're either forced to take money out because you've gotten a little bit older, or you're going to just retire, right, and take it out as long as you're over 59 and a half.
Yep.
The traditional IRA, I kind of explained like the concept of the money growing tax-free. We don't have to spend a lot, or grows tax-free in the meantime. Yeah, tax deferred.
There you go.
And then one other thing I'll throw in there you can see on the slide is the money's just treated as income tax. I actually get that question a lot. When I take money out, is it a capital gain or income tax? And I'm like, I don't know. I took that for granted. I thought that was...
You're not paying the Medicare tax because you already have to pay that, the FICA side of it and all of that, but you are having to pay general income taxes on it. It's not earned income, though, which is another confusing one because people start to get a little, well, is this earned income? So now I can contribute to a Roth IRA when I'm retired. Not the case.
God, we could go so far on that because it's not earned income for most things, but it's earned income if you want to get a mortgage.
Well,
right? They don't count it call it earned income.
I could go down a rabbit hole. Yeah. To be able to qualify for a mortgage when you were retired. So this could be just a simple video, or this could be a very elaborate video. Because if you're qualifying for a mortgage, you're going to have to prove to the mortgage company that you have income coming in. The only way to have income coming in is actually do withdrawals from your IRA and show them that you're taking withdrawals from your IRA, or that they're set to be recurring on a regular basis. They don't care that you have $4 million in an account and you're only buying a $150,000 house. They care that you are getting withdrawals. It's the wildest stuff.
I know. Yeah, I won't. Don't get him started. Right? Hit me with the Roth IRA. So you take the Roth IRA side.
Yeah. So it's a Roth IRA is my favorite. I like the Roth IRA and everything about what it offers. The contributions are going to be after tax, so you're going to pay all the taxes on it. It's going to be tax-free growth on the Roth IRA. They're all going to grow tax-free as long as you access it after 59 and a half. So if you access the growth on it before 59 and a half, there are penalties there. But it is cool because we've talked about before different strategies with the Roth. You could put the principal in, and since you've already paid the balance on it, it's not recommended, but you could take that out if need be for any kind of occasion. Maybe you're like, hey man, something bad happened and I've got to get some money and I don't have any liquidity. That is an option for you. So qualified withdrawals, tax-free. There are no RMDs. Super nice because when it comes to the traditional side or any pre-tax dollars, you're going to have to take required minimum distributions. Government knocks on the door and eventually says, hey, you've never paid taxes on these dollars. We want some money. As far as who it's best for, it's great for young investors, those in a lower tax bracket or those getting started right this second, because you're going to be able to really just soak up so much in compound growth over the years. If you start a Roth IRA at 21 years old, that's going to be able to grow and grow and grow all tax-free. Those that are expecting to be in higher tax brackets in retirement, definitely a great opportunity for you as well.
It's fun because you can actually... I've stretched a number of scenarios where maybe someone's 35, single, and actually has a really, really good income, and you're like, I can still show you that the Roth is the best way to go. And then on the other side, we'll pull up the sort of the comparison chart here we put together. he was just mentioning the contributions being able to come out. It's not that you necessarily want to do that, but every time I work through a plan with a client and they're like, well, I'm technically saving more than enough for retirement. I'm like, okay, well, if you're going to oversave money, always oversave to the Roth, right? In terms of what your number is. I don't mean like put 7,900 in there when the limit's 7. I mean, if you only needed to put in 6, but you're putting in 6,500, that's fine, because if you have that liquidity event, that you could take the money out, there's no problem.
Yeah.
No problems with that. RMDs he mentioned, called required minimum distributions. The IRS says, hey, we let you defer that money in a traditional IRA for all these years. You're getting older. We're going to ask that you take money out now so we can get some of that tax. Definitely something to consider before that. And then he did a breakdown, or kind of started getting into the breakdown there of, why would you choose the traditional versus the Roth? So we put a few ideas together for you. Another one that I would throw in there is when people... and you don't make the decision based on this, but people get a little emotional and they're like, well, the government's going to find a way to tax me even more in the future. And it's like, okay, that's like saying I'm not going to plan to have Social Security there because it may not be there. Maybe you take a fraction of that. Maybe part of it is true, but don't do that.
Yeah, and I've always leaned towards with Roth versus traditional. We've done multiple videos on it prior. If you're going to put $7,000 away, then put the $7,000 in the Roth. Now, if you are needing the tax break to make that $7,000 contribution, so let's just say that you are going to do $6,000 to the Roth because that's all you can afford, but now you're saving by doing pre-tax that extra $1,000 or something, there can be an argument for the pre-tax side. It's a really unique one there, but let's just say that you're putting $7,000 in regardless. If you're doing it just to save a couple bucks on taxes, but you aren't actually saving the tax savings, you kind of hurt yourself on the back end. So
he means like physically saving it, right?
Yeah, investing that money. So because somebody puts in $7,000 and they're like, cool, I put it in Roth, it's tax free. I put it in traditional and it's going to, save me, let's just say $1,400 in taxes. But they go spend that $1,400, they don't actually save it. So then really there's no sense in doing the pre-tax because you didn't take advantage of that tax savings. You instead just blew it on some random stuff.
Well, if you're really nerdy too, like financially nerdy or geeky, as I like to say, there's nothing that says you have to have it all or nothing, right? If you're on the edge of a bracket somewhere, maybe you have some extra income coming in that you know about, you can actually just put enough into an IRA, provided that you will get the deduction, and then the rest of it, put it in the Roth. So there's nothing that says, it's got to be all or nothing. So let's do an example.
Yep.
We got Sarah. We're going with a young person here today. She's 25, makes $60,000, doing good for herself, getting started in life. On one side, we got the traditional scenario. She puts in $7,000, gets the deduction he was just talking about there.
Look at that, $1,400.
Nailed it. That's 20%. 65. She's got $1.4 million, but she's got to pay taxes on that. So if we assume she's going to pay we're guessing, right, 22% tax rate in retirement, she's going to end with, if it all kind of came out, $1.1 million. On the other side, since she's 25 and she's putting in the $7,000, we're assuming not increasing this, she'll still have $1.4 million with the same growth rates and everything, but she gets to keep the full $1.4 million. Okay, right? Like that's the obvious, really simple way to look at it. It's $300,000 extra dollars. It's not the end-all, be-all, but if you're Sarah and you're in that spot right there, and we don't project that she's going to sell some big business or something like that, yeah, come on.
Well, and this really goes back to just what I was talking about. If you're looking at this chart, she gets $1,400 in a tax deduction. Who's to say she doesn't take that $1,400 that she saved in taxes and now put it in a brokerage account? Then you might be able to offset something, because then you can retire and you can say, hey, I'm going to take this brokerage account as my income, keep my income really low, and I can convert this traditional. I could get really geeky on all this.
It's fine. Yeah, I mean, there's
things. So many angles to go. Another thing here, looking at this, the traditional IRA scenario, people are saying, I know how this goes, because they're going to say, well, 22% tax rate, that's ridiculous. That's super high. It could be super high, but once you factor in, maybe she has a pension, maybe she has Social Security coming in, possibly she gets an inheritance, which could kind of throw things off as well, how everything goes. But then she hits 75 years old, and now she has to take money out. What if she doesn't need the money, but she's having to take money out? That could push her into a higher tax bracket. That is not only a cost for tax purposes, possibly a 22% tax rate, but now Sarah's a single filer, and then there's also something called IRMAA, where you're having to pay more in Medicare tax because you're making too much money. I like the Roth. There's countless arguments for that side of things. Now, your CPA will probably catch this. This is usually when the phone rings for us.
but you don't always get a deduction for an IRA. It's a little bit more of an advanced thing here. So
yeah.
I wanted to make sure we pointed this out, that there are phase-outs, I should say income phase-outs for yourself, whether you're single, married, filing jointly, that the government says, well, hey, look, if you put money into an IRA now, we're just not going to give you the deduction, or we're going to give you some percentage of it if you're inside that window. So, for example, the married filing jointly, that window of 126 to 146, that's the phase-out. So if you land in there somewhere, this is your modified adjusted gross income, by the way. If you land in the middle there somewhere, expect that you could put about half, or your deduction would be about half of what you would get. That's where you start getting into that sort of thing too, where someone says, our income's going to be, 185, and we are 31 years old. Well, you don't actually get any benefit there, right, for the traditional IRA. So it gets a little hairy there. What we don't want is for you to keep putting money in, go, so what? I didn't get the deduction. The IRS makes sure that you keep track of that, and that gets to be a little bit of a mess.
Yeah, and it mentions there with a workplace retirement plan. That's the key differentiator there. And there's differences because if it's you that is covered by the workplace plan, there's one number. And if you're married and your spouse has that, it's separate. There's some unique things there that you really want to get geeky on. Make sure that you're working with a CPA to make sure you get right. Same for the Roth, though. Because for the Roth, you've got phase outs because if you make too much money, the government says you can't do a Roth IRA. And so that's where something comes into play where people talk about a backdoor Roth IRA. But let me just debunk something because I actually had an accountant tell clients to do this, and it is completely incorrect and not true. And that is, if you have a traditional IRA already, it needs to be at zero. You need to be at a flat line to make sure you don't make a mess out of this. Because if you make a mess out of it, there's tons of other videos that we can talk about that are how to work through that. But basically what ends up happening is you don't get to convert the entire amount into a Roth if you put the money in the IRA and there's already a balance. So the CPA said, all right, well, you've got $100,000 in an IRA, so just open a new IRA. That balance is zero, and we'll just do the conversions from that one. Doesn't work that way. It's across all accounts.
I wish
the
it did,
IRS
though.
looks at, oh, dude, that would be perfect if that were the case. So be careful and cautious when you're looking at these things and strategies. Again, there's so many rabbit trails that we could go down with this because this is such a great opportunity for people learning, but there's also a lot more things that can be added to the. I could talk for days.
I think, so that's what I was saying at the beginning here was like some of the ways people ask me a question, I take for granted the fact, oh yeah, but not everybody knows that. They're not dumb, and it's not a stupid question. I just deal with it all the time.
Yeah.
Well, we don't spend a lot of time on this, but the advanced strategies, things to consider with the IRAs and the Roth. My favorite is Roth conversions when the market falls and presumably in the same year that you have lower income. I love that. Or if we can reduce your income some other way, right?
Yeah.
I think that's the best because keep in mind, when you convert, you're paying taxes. So if we can show a smaller amount, right, your investments fell. Let's just say the market at some point, maybe never, but it goes down at some point.
Yeah.
Right? Then you were showing a smaller amount to the IRS. The money moves over to the, in this case, your Roth IRA, and it grows back without paying the IRS that money. That's my favorite one there when it comes to the advanced strategies.
Nope, absolutely. Yeah, there's definitely different strategies that you can look at and ways to work this. We've talked about that before, the Roth IRA and when's the best time to do it. There's multiple different people and takes on this that they have. But generally speaking, January 1st, if the market appreciates through the year, we talked about January 1st seems to be the true timeline there. And if you want to play the game, January 1st, wait until see if you can get a market drop. If not, you got to set a timeline somewhere in that year to do the rest of that conversion.
I think probably for me, the biggest takeaway that would be important for someone that's like 30-something, they're watching this now, besides the fact that we'd love to work with you here at Jazz Wealth, so if you go to our website, schedule a call, that'd be great. But I think the biggest takeaway is there's almost I can't think of a good reason to say, if you go through your life with all pre-tax dollars, somehow it'll be fine. Like, don't do that. We don't want to have all your money pre-tax and you get to be 50, 55, 60, and you're like, man, look at all this money, but it's all taxable, 100% of it. We don't want that. Have some diversity there when you can.
Definitely agree.
Man, that's all I got.
Oh, I think it's great. I think you did a great job here.
Thanks. You as well. You don't have a joke?
No.
Oh my God.
No, I
This
didn't
is
bring
what
my
we
coffee
do. You
cup.
tell a
I
joke.
didn't bring my coffee cup. I was just like, we're back. We're just back.
I had the nastiest of jokes. Oh.
Good. Thank goodness.
I'll save it for next time. Stay tuned to hear that joke because I'm not going to forget it. It's good. All right, adios.